I mean, essentially what you just said to me, because no companies outside Indonesia are going to be economically mining nickel for under $6. That's what you just said, right? Because like you and I have been on the finance side of things for long enough, and we've done enough in mining to know when companies kind of splurge out their AISC numbers, those numbers can be managed, manipulated to a degree. Okay, well, just say that. Just it's a big macro statement, not a reflection on any your companies or any companies I know, but I've been in rooms where that happens, and things can look economic when you're using AISC. So it gets really, really difficult when you've got companies that are saying, hey, we're economic at $5 nickel. But the underlying reality is that they need $6 nickel to actually be profitable. Okay, so that happens. Okay, and I'm talking about gold, I'm talking about copper, silver. All companies, play that game to a degree. So your assertion that no companies can economically mine for under $6 is, I mean, are there exceptions to this outside?
I wouldn't say economically mine. It basically get a project financed. So, again, if you need $1 billion, again, Voisey's Bay underground, Boy Valley is, $1.5 billion. Onapping Deepest Glencore's project, that's $800 million. Those are the scale of the tickets that are required to bring new nickel production. And so the cash cost, again, using Dumont, feasibility study numbers as an example, the cash cost is around $3 a pound. The all-in sustaining cost is well below $4 a pound. So again, they'll print money at a $6 nickel price in the future. It's just a matter of getting enough, getting that $1 billion to be able to build the plant, to be able to, to make that quantity of nickel and generate a return on that $1 billion investment. But again, this is something you bring up the case of the C1 and AISC. I would really encourage investors. There's a bunch of the high grade is sexy, and it looks great. But I would really encourage investors, if you're looking at a high grade operation, to go to the free cash flow page, because the issue with a high grade mine is that you have the exploration cost. You then have to develop the mine to get out to where you just found the nickel that you just drilled, and that number piles up pretty quickly. And so they might say, oh, we've got this cost, and then we've got this cost, and you think, oh, there should be making $2 to $3 a pound, and then you go to the free cash flow statement and you look to see actually how much free cash flow they generate, and none of it's there. Because when you do all in sustaining costs, that's one of those things where companies play a little shell game in terms of, okay, well, that's not sustaining capital, that's exploration and development. So we'll leave it on that side of the fence. So their AISC number looks lower. So, but yeah, no, that's it. I would highly encourage, people to do that. There's one example in the industry that, is kind of sort of very much, twisted the definitions of C1 cost, more than I think
we all know
a lot of
who
other
you're talking
people
about.
would be comfortable with.
Yeah, I think let's definitely not mention any names, but I don't think it's unusual. It happens all the time. I see it across all commodities. It's the dance that the CFO plays, and that's why I think fundamentals have got to be there. You do, need to look through the MD&A.
The cash flow statement never lies.
Never lies.
That is the best of all of the financial statements.